Let's apply what we've learned to a real-world scenario, the COVID-19 pandemic. This period offers a unique case study in understanding the interplay between central bank actions, market responses, and the resulting economic ripple effects. As the COVID-19 swept the globe, economies faced unprecedented challenges. Central banks, including the US Federal Reserve, responded by slashing interest rates and implementing quantitative easing. They effectively printed money, injecting enormous liquidity into the economy to stave off a financial crisis. This infusion of cash aimed to support struggling businesses and consumers. However, it also laid the groundwork for inflationary pressure. As the economy started recovering, the increased money supply began to chase a limited supply of goods, leading to a rising prices, a classic inflation scenario. In response to a low interest rate and a high liquidity, we saw a surge in stock markets and unprecedented boom in cryptocurrency. Investors flush with cash and looking for returns in a low yield environment, they turned to these markets. Cryptocurrencies in particular were seen as a hedge against inflation and a leading indicator of inflation. However, as inflation fears grew, expectation of interest rate hikes started to take hold. These anticipation led to volatility and a significant pullbacks in crypto market. The mere expectation of tightening monetary policy was enough to shift investor sentiment. The real estate market also tells a compelling story. Initially, low interest rate led to a boom in property purchases and rising house prices. But as central banks started hinting at rate hikes to combat inflation, we witnessed a cooling down in the real estate markets. These events weren't isolated. They had global repercussions, affecting economies and markets around the world. Countries with different levels of exposure to global financial systems experienced these shifts in varying degrees.